You need to see this chart right now, because what's happening with the gold-silver ratio hasn't happened since right before the last two major market crashes. And I'm not talking about small corrections, I'm talking about 2008. I'm talking about 2020. The kind of events that wipe out retirement accounts and reshape the financial landscape for a generation. The gold-silver ratio just hit levels we haven't seen in years. And if history is any guide, we're standing at the edge of something massive. Let me show you exactly what this means, why it matters more than almost anything else happening in markets right now, and what you need to do about it before it's too late. First, let's talk about what this ratio actually is, because most people have no idea they're looking at one of the most powerful predictive indicators in financial markets. The gold-silver ratio is simple. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number is sitting around 85 to 1. Meaning you need 85 ounces of silver to equal the value of 1 ounce of gold. Now, you might be thinking, so what? That's just a number. But here's where it gets interesting. Throughout history, this ratio has averaged around 60 to 1. Sometimes it drops to 40 or 50 during boom times. But when it spikes above 80 or 90, something is very, very wrong in the financial system. And every single time it's hit these extreme levels, a major crisis has followed within months. Let me take you back to 2008. In March of that year, the gold-silver ratio exploded to 85. Most people weren't paying attention. The stock market was still near all-time highs. Real estate was supposedly fine. The mainstream narrative was that everything was under control. But the ratio was screaming that something was broken. 6 months later, Lehman Brothers collapsed. The entire global financial system nearly imploded. Trillions of dollars in wealth evaporated. Retirement accounts were cut in half. And the people who saw the warning signs in the gold-silver ratio, they were the ones who protected themselves. Fast forward to early 2020. January and February, the ratio started climbing again. By March, it hit an absolutely insane level of 125 to 1, the highest reading in modern history. And what happened next? The fastest stock market crash in history. The COVID panic. Central banks printing money like there was no tomorrow. The entire world economy shut down. Again, the gold-silver ratio gave you the warning before the mainstream media even knew what was coming. Now look at where we are today. The ratio has been hovering in the 80s. It's been stubbornly high for months. And here's what most people don't understand. This isn't just some random technical indicator. This ratio is telling you something profound about fear, liquidity, and what the smart money is doing behind the scenes. When the gold-silver ratio spikes, it means gold is outperforming silver by a massive margin. And that only happens when there's a flight to safety. When institutions, central banks, and wealthy investors are scrambling to protect their wealth. Gold is the ultimate safe haven. It's what you buy when you don't trust anything else. Silver, on the other hand, is more industrial. It's used in electronics, solar panels, medical equipment. When the economy is humming along, silver does great. But when fear takes over, everyone rushes to gold, and silver gets left behind. So when you see this ratio spike, what you're really seeing is panic. Institutional panic. The kind that happens before the public even realizes there's a problem. It's like watching the rats leave the ship before it starts sinking. The smart money knows something, and they're positioning themselves accordingly. Let me give you another example. In 2011, the ratio dropped to around 30 to 1. Silver was on fire. The economy was recovering from 2008. Industrial demand was strong. Investors were optimistic. But then the European debt crisis hit. Suddenly, fear came roaring back. The ratio climbed back above 50, then 60, then 70, and silver got absolutely crushed while gold held steady. The people who understood this ratio saw it coming and adjusted their positions before the carnage. Here's what's happening right now that should terrify you. We're seeing the same setup as 2008 and 2020, but with even more dangerous underlying conditions. The national debt is over $36 trillion. That's trillion with a T. Interest payments alone are now over $1 trillion per year. That's more than we spend on defense. The government is borrowing money just to pay the interest on the money they already borrowed. That's not sustainable. That's a death spiral. Meanwhile, commercial real estate is imploding. Office buildings are sitting empty. Banks are holding billions in bad loans on properties that are worth half what they were a few years ago. Regional banks are quietly failing. You're not hearing about it because the Fed is doing everything they can to keep it quiet. But the stress is building, and the gold-silver ratio is picking up on it. Then you've got the geopolitical situation. The BRICS nations are actively working to undermine the dollar. They're settling trade in their own currencies. They're accumulating gold at record levels. China's central bank has been buying gold for 18 consecutive months. Russia, India, Turkey, they're all doing the same thing. They see what's coming. They're preparing for a world where the dollar isn't the reserve currency anymore. And when that shift happens, it's going to be catastrophic for anyone holding dollar-denominated assets. The gold-silver ratio is reflecting all of this. It's telling you that the smart money is terrified. They're buying gold as insurance. They're not buying silver because they don't believe in the industrial economy right now. They think we're headed for a contraction, a serious one. Now let me show you something even more interesting. Look at what happened after those previous spikes. In 2008, after the ratio hit 85 and the crash happened, silver absolutely exploded. It went from around $9 an ounce to nearly $50 by 2011. That's a 450% gain in less than 3 years. Why? Because after the initial panic, the Fed started printing money. Quantitative easing. Stimulus. All that newly created money had to go somewhere. And silver, being more volatile and cheaper than gold, became the rocket ship for investors looking to capitalize on the inflation that was coming. Same thing in 2020. After the ratio hit 125 and the crash happened, silver went from $12 to over $30 in just a few months. Again, massive gains for anyone who understood the pattern. The ratio spikes during the panic. Then it collapses as silver catches up during the recovery, and the people who position themselves correctly make fortunes. So here's the critical question. Are we in the panic phase right now, or are we about to enter it? Because the ratio is elevated, but it hasn't hit those extreme 100+ levels yet. My read on this, based on everything I'm seeing, is that we're in the warning phase. The ratio is telling you to get ready. The crash hasn't happened yet, but the conditions are all in place. And when it does happen, it's going to be fast and brutal. Think about the mechanics of what's coming. The Fed has painted themselves into a corner. Inflation is still a problem, but the economy is weakening. If they keep rates high, they risk triggering a recession and a wave of defaults. If they cut rates and start printing again, inflation comes roaring back. There's no good option. They're trapped, and the market knows it. When the crash comes, here's what's going to happen. First, there will be a liquidity crisis. Everyone will be scrambling for cash. Stocks will plummet. Bonds will get crushed. Even gold might dip initially as people sell everything to raise cash. But that dip will be brief, because very quickly the Fed will panic. They'll cut rates to zero. They'll restart quantitative easing. They'll print trillions of dollars to stabilize the system. And that's when gold and silver will take off. The gold-silver ratio will collapse from wherever it peaks during the crisis. Maybe it hits 100, maybe 120, maybe even higher. But then, as the money printing starts, silver will outperform gold by a massive margin. The ratio will drop back to 60, then 50, maybe even lower. And if you're positioned correctly, you'll make life-changing returns. Now, I want to pause here for a second because this is important. If you're sitting on a significant amount in retirement accounts, like over $100,000, you need to understand how a gold IRA works. I put together a free guide that breaks down exactly how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. This isn't about speculation. This is about protection. When the system breaks, you want real assets, not paper promises. Check it out if that's relevant to your situation. All right, back to what's happening. Let's talk about the supply side of this equation because it's absolutely critical to understanding why silver is going to explode when this ratio corrects. Silver production has been flat for years. We're not finding major new deposits. The existing mines are getting more expensive to operate. And at the same time, industrial demand is skyrocketing. Solar panels use massive amounts of silver. Electric vehicles use 3 times more silver than traditional cars. 5G infrastructure, medical devices, water purification, the list goes on. We're using more silver than we're producing. And that deficit is growing every year. Now combine that with investment demand. When the crash comes and the Fed starts printing, investors are going to flood into precious metals. But here's the thing. The silver market is tiny compared to gold. The entire above-ground supply of investment-grade silver is worth maybe $50 billion. That's nothing. Apple could buy the entire global silver market with the cash they have sitting in the bank. When even a small percentage of the trillions of dollars in the financial system tries to move into silver, the price is going to go parabolic. And here's where it gets really interesting. The paper-silver market is completely disconnected from the physical market. On the COMEX, the futures exchange where silver is traded, there are claims on hundreds of millions of ounces of silver. But the actual physical silver in the vaults? A tiny fraction of that. It's a fractional reserve system, just like banking. And it works fine as long as nobody asks for delivery. But when a crisis hits and people start demanding physical metal, the whole system could implode. We've already seen signs of stress. Premiums on physical silver coins and bars have been elevated for months. Dealers are struggling to keep inventory. Mints are running behind on production. The disconnect between paper prices and physical availability is growing. And when that gap becomes too obvious to ignore, there's going to be a rush for the exits. The paper price will have to catch up to physical reality, and that means a massive spike in the silver price. Let me give you a historical parallel that most people don't know about. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive positions in both physical silver and futures contracts. The price went from $6 an ounce to $50 in just a few months. The ratio between gold and silver collapsed to 17-1. Now, the Hunt brothers eventually got crushed because they were using leverage, and the exchanges changed the rules on them. But the point is, it showed how explosive silver can be when there's a supply squeeze. And we're setting up for a squeeze that could make 1980 look tame. Think about what's different now. In 1980, silver was primarily a monetary metal. Today, it's essential for modern technology. You can't build solar panels without it. You can't manufacture electronics without it. The industrial demand floor is much higher than it was back then. So when investment demand kicks in on top of that industrial base, the price has nowhere to go but up. And here's the kicker. Central banks don't hold silver. They hold gold. So when they're buying gold to protect their reserves, they're driving the gold-silver ratio higher. But individual investors and industrial users need silver, and there's not enough to go around. That imbalance is going to resolve itself violently when the crisis hits. Now, let's talk about timing, because that's what everyone wants to know. When is this going to happen? And the honest answer is, nobody knows exactly. But we can look at the warning signs and make educated guesses. The gold-silver ratio is one warning sign. It's elevated and staying elevated, which tells you the smart money is nervous. But there are other indicators flashing red, too. The yield curve has been inverted for over a year. That's when short-term interest rates are higher than long-term rates. And historically, every time the yield curve inverts, a recession follows within 12 to 18 months. We're right in that window now. Corporate debt is at record levels. Companies borrowed heavily when rates were low, and now they're struggling to service that debt as rates have gone up. We're seeing an increase in defaults and bankruptcies. That's going to accelerate. The housing market is frozen. Prices are still high, but sales volume has collapsed. Nobody wants to sell because they'd have to give up their low mortgage rate and buy a new house at 7%. So inventory is tight, but affordability is terrible. That's not a healthy market. That's a market waiting for a catalyst to break one way or the other. And when it breaks, it's probably going to be down. Consumer savings are depleted. During the pandemic, people built up savings from stimulus checks and not being able to spend money. That's all gone now. Credit card debt is at record highs. Delinquencies are rising. The consumer, which drives 70% of the economy, is tapped out. They can't keep spending at the rate they have been. And when consumer spending rolls over, the economy follows. All of these factors are building pressure in the system. And the gold-silver ratio is reflecting that pressure. It's like a seismograph picking up tremors before the earthquake. The question isn't if something is going to break. The question is, what breaks first and how bad it gets. My best guess, based on the historical patterns and the current setup, is that we're going to see the crisis unfold in the next 6 to 12 months. Maybe sooner if there's a triggering event, a bank failure, a geopolitical shock, a debt ceiling crisis, something that causes a sudden loss of confidence. And when it happens, it's going to move fast. You won't have time to react if you're not already positioned. So what do you do? First, understand that this is about protection, not speculation. The goal isn't to get rich quick. The goal is to preserve your wealth through a period of extreme volatility and potential currency debasement. Gold is your insurance policy. It's what you hold when everything else is falling apart. Silver is your upside. It's more volatile, but it has the potential for much bigger gains when the ratio corrects. The ideal allocation depends on your situation, but a common approach is to hold more gold than silver by weight, but understand that silver will likely outperform on a percentage basis. Some people do 70% gold, 30% silver. Others do 50-50. It depends on your risk tolerance and how much volatility you can stomach. Silver can swing 5% in a day. Gold is more stable. But both are going to be essential in the environment we're heading into. And here's something most people don't think about. When you buy physical metal, you're removing it from the system. You're taking delivery of a real asset that can't be printed, can't be debased, and can't be confiscated easily. That's powerful in a world where governments are desperate for revenue and central banks are destroying the value of paper currency. Physical metal in your possession is true wealth preservation. Now let's talk about what happens after the crash. Because this isn't just about surviving the downturn. It's about positioning yourself for the recovery. And if history is any guide, the recovery in precious metals is going to be spectacular. After 2008, gold went from $800 to $1,900. Silver went from $9 to $50. After 2020, gold went from $1,500 to over $2,000. Silver went from $12 to $30. And in both cases, the people who bought during the panic made fortunes. This time is going to be even bigger because the response is going to be even more extreme. The Fed can't let the system collapse. They'll print whatever it takes, and that money has to go somewhere. It's going to flood into hard assets, real estate, commodities, and especially precious metals. The gold-silver ratio will collapse as silver catches up, and the people who understand this pattern will be positioned to capture those gains. But here's the thing you need to understand. This isn't a trade. This isn't something you do for a few weeks or months. This is a multi-year cycle. The crash, the response, the inflation, the recovery. It takes time to play out. You need patience. You need conviction. And you need to ignore the noise. Because there will be plenty of people telling you that gold and silver are barbarous relics, that crypto is the future, that stocks always go up. And they'll be wrong. Just like they were wrong in 2008. Just like they were wrong in 2020. The gold-silver ratio doesn't lie. It's been a reliable indicator for decades. And right now, it's telling you to prepare. The crash is coming. The question is whether you'll be ready when it does. Whether you'll have protected your wealth with real assets. Whether you'll be positioned to profit from the chaos. Or whether you'll be caught off guard like the majority of people who trust the system and believe everything is fine. Look at what the insiders are doing. Central banks are buying gold at the fastest pace in decades. Billionaires are moving money into hard assets. Smart investors are reducing their exposure to overvalued stocks and bonds. They're not doing this because they're pessimistic. They're doing it because they're realistic. They understand the math. They understand that the current system is unsustainable, and they're protecting themselves accordingly. You have the same information they do. You can see the gold-silver ratio. You can see the debt levels. You can see the warning signs. The difference is whether you act on it or not, whether you take this seriously or dismiss it as doom and gloom. Because when the crash comes, and it will come, there won't be time to prepare. The moves will be too fast. The panic will be too intense. You need to be positioned now while things are still relatively calm. This is your warning. The gold-silver ratio just predicted the crash. It's done it before, and it's doing it again. The only question is what you're going to do about it. Are you going to protect yourself? Are you going to take action? Or are you going to hope that somehow this time is different? Because I can tell you right now, it's not different. The patterns are the same. The outcome is going to be the same. And the people who prepare are going to be the ones who survive and thrive on the other side. The clock is ticking. The ratio is elevated. The warning signs are everywhere. Don't wait until it's too late. Don't be the person who looks back and wishes they had listened. This is your moment to act, to protect your wealth, to position yourself for what's coming. The gold-silver ratio has spoken. Now it's up to you to listen.